Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the Invesco QQQ Trust. This is basically the ETF that tracks the tech sector. Again, ticker symbol QQQ. And as I zoom in here, you'll see that I've left my lines on the chart from last week, like I do all the time, to see how the forecast worked out. And on Monday, we came right down to that support level that I drew last week, hit my target, and then bounced. Now, this happened a little bit sooner than I expected, but nonetheless, it did hit that target. We bounced off of support. And what does that mean for next week? Well, if you look above the market right here, you'll see a key resistance area just below 360. Now, in addition to that, we have 1, 2, 3, 4, count them, 4 green candles in a row. That's known as a stale green light. However, today's candle, if I zoom in a little bit more, you can see we have hardly any shadow above that candle on slightly higher volume. So this forecast is going to be a little bit different than some of the others that I'm going to be looking at here. But I think on Monday we could go just a little bit higher. But look down below, we have the CCI in overextended territory with the stochastics at some of the highest levels we've had all year. So that's overbought. It's overextended, right? So Monday, we might go a little bit higher, but I think by the end of the week, and I'm going to look to the left as I draw to the right to get that angle, drawing my zip line here, you can see that my target for next week is going to be 338.39. That should bring us very, very close to that 20-period moving average. So for you option traders out there, I think we're more or less stuck in this range right here for a little while. We have to keep an eye on this key support level down here, because once that breaks, we'll have a slew of sell stops being triggered off as traders go and make a move to protect any positions that they have. Now, I'm going to take a step back. I'm going to spend a little time on this one. Take a look at the moving average crossovers. See this now? Interestingly enough, we came right up to the 50-period moving average. And with that, you can see that the 100-period, this is the red line, the 100-day moving average right here, is still converging in on the 200. In order for that line to go up, we have to get the prices above that moving average, and I doubt very much that we're going to see that anytime soon. So while the markets have had a rally this week, that moving average is continuing to move closer to that 200-period moving average, and once that crosses, that is going to spark a lot more program selling. We're going to see a lot of fund managers adjusting positions. So long term, I'm still very bearish. Short term, again, like I said, I think we could see just a little bit of a rally on Monday, but then right back down to the moving average. And then we'll have to go week to week on that forecast. All right, so that is for the Qs. Let me go back now and go to the IWM, which is the Russell 2000 ETF right there. You can see I left my lines on the chart. We came within pennies on Monday of hitting that target. Remember last week, if you go back and listen to the recording, all I did was I moved this previous forecast over and extended the timeline on that more or less. Came within, I think it was 6 cents of hitting that target, and then guess what? We bounced again. Now, IWM, let me erase these lines and I'll redraw so we can keep these nice and clean. If you remember, months ago, actually back in May of last year, I established the 210 level as a key support level for IWM. And I was constantly talking about the option traders and how that 210 level was going to be a critical point where we were going to reverse all of our positions from positive delta or bullish to negative. And then what happened? 210 was broken and we did very well with our put spreads. Now, if we look at that 210 level, there's a concept that, again, I talk about all the time, is that when a support level here and here is broken, like we see here, that line reverses its role and turns to resistance. So as IWM continues to move higher, it's getting closer and closer to that resistance, at which time I do believe that we're going to see some selling. Down below, there's still a very minor gap right there. See, if I magnify that, you'll see the gap. It's very, very small, but it's still a gap. And 80% of the time, gaps do fill. So here's another one. Like the Qs, I think we're going to go up maybe on Monday. Maybe not. I'm just going to do this little blip of a zip line there. And then I think you're going to have to keep an eye on the volume, because once the volume drops, again, I think we're going to move right back down. Notice how I drew that angle on the zip line. Watch, I'll duplicate this and show you where I'm drawing from. See these angles back here and even here, this little area right there. I take that and then I duplicate it, because the markets tend to go up and down in the same angles. And we're very much in a cyclical pattern here. You can see it's almost like a sine wave, perfect wave pattern. And so keep your eyes on that moving average. Now down below, what does this support level mean down here right around 188? Well, this new support level down here is going to react in a similar way to the way the support level was once a support level and then broken. This will be as significant, because once we break out below that 188 level, you're going to see, again, additional selling as we step down into this bear market. So that's IWM. Now let's take a look at the spiders, ticker symbol SPY right here. We came down on Monday, didn't hit my target. We did bounce off of this support. I'm going to keep that in place. I'm going to erase this, but ultimately I do believe we're going to get back down to test that support level. Now this is a little bit different than what I mentioned in the Qs and in IWM, because if you look at the stochastics and the CCI down below, see right here as I magnify that, the CCI is extremely overbought right now. It's right at the top of that scale, but it's starting to hinge. It's starting to hinge as we're getting a couple of days of volume dropping there. Again, a stale green light. There is a resistance all the way up here. I don't think we're going to get that high, but that is a key resistance level. And again, just like what we saw earlier in the other markets, is that we have a wide trading range here, and the markets are more or less oscillating within this range. I mean, you have to keep an eye on what's going on around the world. I mean, with supply chain shortages, with Ukraine and Russia, and inflation and gas prices, you know, sometimes it's hard to believe that we even rallied today or this week alone with all that's going on. The Fed, knee-jerk reaction initially. We saw the markets rally, then they came off on the same day Powell was speaking. Again, I don't believe anything that the Fed is doing is going to help the inflation problem that we have right now. 25 basis points is basically going to do nothing. And so we have to keep an eye on that as well. So for my forecast, I do think that we're going to go up just a little bit, maybe. This is a big maybe right there. And then just like the rest of the markets, looking to the left as I draw to the right, right back down to that moving average. So SPY, the target there is, look at that, right to the dollar. It's $430 right there. You know, when I draw these to a decimal point, I don't pick it at the decimal point, obviously. I just read where that little data box pops up when I'm drawing that line. So, you know, we have a lot of scorekeepers out there that hold me to the penny, and I'm okay with that. But if you're trading, you don't have to be that exact. In fact, most of the option trades that we put on, a good majority of them, over 80% of the trades we put on, make money, even when the markets move against us, because that's how good the option markets are right now. On that note, really quickly, before I get into the VIX and the diamonds, if you're interested in learning how to trade options or how to read the charts or how to really manage your positions using our 1% risk management rule, right? The 1% rule for managing risk is something I came up with in 1988. It helps you relax and sleep at night and not have to worry that you're going to suffer a catastrophic loss. You can go to marketrebellion.com, talk to one of the representatives, and find one of the services or trade alerts that might fit best for your account. And with that, let me move right on to the VIX. This was extremely interesting here today. I am keeping my long-term target at 41.88. I'm keeping that in place. Now look what's happened. The VIX sold off on that bearish engulfing candle right there. See that? It sold off on the bearish engulfing candle. But as I zoom in here, look what's happening. We closed the VIX very close to the low, but down below here, the CCI is actually going up while the VIX had closed on its lows. That is a very rare occurrence. You don't normally see that. In fact, you can go back at any time and you can look at when the market's off. Like here, for instance, you see the VIX closed on the low, but the CCI was still moving lower and even crossing down below that momentum line. So this is, again, a rare occurrence that you see that happening. And what does that mean for the VIX? Well, that happens to be a very bullish indication short term. The other thing is we have a stale red light, 4 red candles in a row. I'm going to say maybe, again, like the rest of the markets, we might see the VIX go a little bit lower. So this is a maybe tick mark there. But then I think the VIX is going to go right up in the same angle that we see here and then possibly accelerate if we cross over that 20-period moving average. So that's going to be a big tell for the coming months, whether or not the VIX gets back up over that moving average, and I do believe it will. Now, last one here, and then I'm going to talk a little bit about the general markets as a whole. Diamonds did not even come close to hitting that target. The support level is still in place, but as I erase these lines, I want to point out to you something, again, very interesting. Like the VIX, the CCI is going against the price action. So we have a key resistance area up here right around 351 for the diamonds. And we have a lower volume day. So I don't think the diamonds are going to get that high. In fact, I don't think they're going to move up all that much at all. So I'm going to just move that right down. Again, looking at the angles of the past action here, I'm putting a downside price target on the diamonds of 337.57. Now remember, with the Dow closing up about 274 points, of course, I talk about the 52-week high-low list, and you can see here the New York Stock Exchange had almost a 1-to-1 ratio, 52-week highs, 59 right there, 52-week lows, 58, so it's almost exactly matched 1-to-1. But you would think that with the markets going up, we'd have many more 52-week highs hitting, and that was not the case. If you look at the NASDAQ, we had 62 stocks hit a 52-week high, and we had, look at that, 85. So we had more stocks hitting a 52-week low than 52-week highs, not in a big ratio like we did last week, but that still is a weak breadth of the market. And in the description box below, I've put the link to this website, the Wall Street Journal website. It's WSJ.com. And you could bookmark this. I bookmark this on my page, and I check it 3 times a day at least. And I look for signals, then maybe a shift in the breadth of the market, and then I might adjust my positions accordingly. Now, finally, again, I've said this over and over again, watch what you're listening to, the news feeds, watch what you're reading, be very careful. There's a lot of folks out there in the globalist community worldwide. You could feel it, they're pushing for a war. All right, I'm not for any war here. I'm a military veteran. I do not like war. If you ask any military vet, no one wants to see war, especially the military folks, of course. But you can feel it, right? They're trying to push. They're trying to get Ukraine to get into NATO. Why? So they can have an excuse to fight back on Russia. While all of this is happening, there's a lot of people that debate me on this, but while all of this is happening, I want you to keep an eye on Taiwan and China. Watch what's happening over there. I really don't know how significant that's going to be for a market sell-off, but it's something that we don't want to be caught off guard. Keep an eye on your positions if you're long anything. I know that a lot of people are still in the buy-hold camp. Make sure you're using good risk management principles to protect that. And of course, make sure you keep your eye on the charts. I have a Twitter page. If you're looking for information during the course of the day, I put that out there. It's the Option Oracle. You can look at that and then keep in touch as I post there. I have the Market Guys Facebook page where I've been putting out some articles there as well. Interesting thing that I posted on social media is that found out that there's a lot of rare earth metals that are being used for 5G antennas, and there's a shortage of these. So commodity ETFs are in play right now. You want to keep an eye on those as a hedge against inflation. On a side note, I'm just giving one away. Last week, we put a trade alert out to our option traders and to our equity traders on BITO. This was a triangle breakout that officially confirmed today on higher volume, and we got long this through a synthetic ratio put right. And this is working out very, very well. Again, this is something that we put out through Market Rebellion. I'm throwing it out there because look at this. Triangle breakouts are very reliable, but not only are they reliable, but you wind up becoming very profitable when you capture the right side of that breakout. And that's exactly what's happening right there. All right, that's related to Bitcoin, obviously. And with that, I'm going to wish you a great weekend. Again, keep your eye on the charts. Make sure you're managing risk, and I'll talk to you next week. So long.